Bristol-Myers continues to fall, down 37% over the last 12 months. It is now at a new 52-week low, although we do see a nice starting yield of just under 6%. So do we have a golden opportunity to add a company with not just a nice forward yield, but also long-term real strong growth for the portfolio? Now we're going to do a deep dive into this company, understand where the issues lies, as well as if there is some very strong growth. We'll also talk about the dividend safety score, looking at some underlying financial metrics. We want to touch upon very briefly at their pipeline, what they have coming over the next few years, and we'll look at not just insider movement, buys and sells, but also what the institutions have been doing over the more recent quarter. We'll also take a quick look at their top line revenue, just to understand if there is much growth over the more recent period, as well as their bottom line net income, any red flags we need to be concerned about. Likewise, we'll do a very similar analysis on the balance sheet, a quick health check, total cash versus their total debt. And what we also want to do is just pull out one or two slides as a reminder from their results over the latest quarter, so you understand as well the forward guidance for the full year of 2024. And importantly, we are going to take a look now with the revised numbers. What is the valuation saying in terms of an intrinsic value? What is our acceptable buy price of BMY? And given our investor margin of safety, is there enough for them just in case? And we'll also see what are Wall Street forecasting over the next 12 months. Now, as a quick reminder of this company, it has suffered massively. We can see down 37% over the last 12-month period. And if you've been a shareholder over the last 10 years, well, you would be down negative 15%. Bear in mind, if you were reinvesting those dividends, it would be a little bit better, but still a terrible performance of any investment over this period. And we can see all-time highs nearly 2 years ago at around $81, and the share price right now is sitting at half that. As we mentioned, a yield near that 6% level, and we do have just one buy rating from Seeking Alpha with a double hold from Wall Street as well as Quant. Now, just a quick reminder with this company and their top line revenue, if you're a regular viewer, you know 3 to 7% baseline is what we want to see at a bare minimum for a more mature company. What we notice is, yes, we do see some nice growth, 16 billion in 2014. That is pretty much tripled over the more recent year at 45 billion. But when we do take a look on a graphical basis, what you will note is growth up to 2020. But since that point, it has remained fairly flat. So one of the concerns we are looking at today is whether or not we will see some growth over the future, as over just the last 4 years, we can in fact see their top line has really moved very marginal from 42.5 billion to around 45 in 2023. Now, how does their bottom line compare, their net income? And what we in fact see is 4 times growth, so 2 billion in 2014, 8 billion in 2023. But when we do take a look at it on a graphical basis, the main thing we note is a lot of inconsistency, and even over the last 4 years, like we saw with the revenue, there hasn't been massive growth over the period. So another concern, not just their top line revenue, but also their bottom line net income. Are they going to be able to turn this around and see continual growth over both top line and bottom line? Now, in terms of the health of the company, total cash and short-term investments, they're around 7.4 billion in 2014. Latest quarterly report just under 10 billion. So we can see their cash position has increased, although very inconsistent year on year. We do note around 10 billion, looking fairly healthy. But again, just in isolation, that number doesn't really tell us too much, which is why we always compare it to their total debt numerically and directionally, which we can see has grown very rapidly, 7.8 billion in 2014, 57 billion in their latest quarterly report. So something just to bear in mind, their cash is a lot smaller, as we can see, than their total debt, which has increased over the longer term. But again, over the more recent period, in fact, we do note they have been paying down some of that debt, and we will talk about their capital allocation when we come to their investor presentation. Something to consider, as this will directly correlate to their dividend safety, which we will cover shortly. When we take a look at their performance versus analyst estimates, we do know over the last 3 quarters, they have beaten. Over the last 4, though, we do see 1 miss, so a 75% track record. And when we look forwards, in fact, we see the next 3 quarters, they are anticipating negative growth to the earnings per share in relation to the year-on-year performance. Something we need to factor into our analysis. Now, their earnings per share estimate is very low for 2024 due to their acquisitions, which we will take a look at. December 2025, though, if they do hit what they're expecting of 692, forward P 5.81, looking very, very low. So it could be justified that it is very low, or it could in fact give us a golden opportunity, and that is what we are trying to understand in today's episode. Valuation, they do get an A grade. Now do understand that we do typically like to look at the P on a non-GAAP basis, but as we said, it is very skewed due to this year's being a little bit of an outlier in compared to others due to the acquisitions. We can see the sector median 19.38, and when we take a look at the other valuation models, which will give us a more accurate measure of this company, like for example the price to cash flow 4.48 with others at 15.42, we can see some golden opportunities. But again, it will depend on which methods you do like to incorporate into your own analysis. We then move on to the growth grade. Now they get a D-, and actually it does make sense. So when you look year on year, their growth of negative 0.7% when you compare it to the sector median high single digit of 7%. When we take a look at the revenue growth, in fact, pretty much flat forward looking, whereas the sector median 8.7%. And one thing that we always like to draw your attention to is the earnings per share over the next 3 to 5 years. Negative 5%, where we can see others double digit at 11%. So in reality, this D- does make a lot of sense for BMY, not the greatest in terms of the growth aspect. We then move on to the profitability grade, an A+. When we take a look at their gross profit margin, a lot better, 76% in the sector median of 57%. When we take, however, look at a net income margin on a trailing 12-month, negative 13%, whereas the sector median, negative 4%. So what this tells us about the industry as a whole, they haven't performed that well in the more recent year. In fact, they've made a loss. This is very similar to BMY, although their loss is larger, as we can see. And when you do look at other metrics, for example, cash from operations, 13.72 billion, a lot better than the sector of negative 16. Hence why overall on a profitability grade, it does get an A+. But again, do bear in mind you may prefer to look at some of these metrics than others. Not all of them will be relevant for this company. So in summary, for this part, it is a buy rating from Seeking Alpha, a double hold from the other two analysts, an A on the valuation, a D- on the growth, and an A+ on profitability. Now, when we take a look at their performance versus others in the sector, remember this is the pharmaceuticals. We have Merck, we have Zoetis, GSK, and a few others. No surprises over the last year, even with those dividends reinvested, the worst performer down negative 34%. Over the last 5 years, very marginal growth, again one of the worst performers. And when we extend it over the last 10 years, you do not really want to be investing in anything that over a 10-year period is only returning you a total return of 15%. Having said that though, with BMI, this is past performance, historical over a 10-year period. We don't know what the next 10 years will hold. This has no relevance to future performance. Always interesting to note though, just something that we do want to make clear. Now, one thing that we always like to look at are companies, are what they have in their pipeline, and we can see they have over 55 compounds in development, and this covers over 40 different disease areas. Now, on other episodes, we have run through the different phases. We effectively have phase 1, phase 2, phase 3. Further along the phase, the more likely it is to be released into the masses. And what we can see here are just a number of them, the different phases. We won't go into too much detail as we have covered this previously, but what we are trying to say here is that this is a company that is reinvesting a lot of their money into R&D, also trying to bring out a lot of new products so they can help bolster their top line. We then move on to the insider ownership, 0.09%. Now, we do note 2 instances of insider buying of around 673k. However, 2 instances still over the same time period, 12 months, we notice more insider selling of 1.15 million. However, when we do take a look, in fact, over the last quarter, we see no movement from insiders. The same to be said from Q1. So in actual fact, the more recent insider movement is Q4 of 2023, where we see insider buying of 673k. When we take a look at who these insiders are, well, in fact, we can see there's the CEO who did buy on 2 occasions, 28th of November, 5th of December, and as we can see, for a total of over 5,000 shares, and we can see here around $250,000. Let me know if you think that is a bullish signal. You could in fact argue that this is quite outdated. In fact, the share price right now does sit at around $39, $40, so a lot lower than what he paid for. But as always, let us know, maybe this is something you would like to include, maybe not, because as we said, we are talking about the end of 2023. When we take a look at institutional ownership, well, 76%, we see 8 billion or 8.4 to be exact worth of sales over the last 12 months. A lot more buying, 51 to be exact, over the same time period. And we also see over the more recent quarter, Q1 institutions have been buying more. So overall, fairly positive. You could argue we note the more recent insider buying, and over the more recent quarter, as well as over the last 12 months, we see institutions buying more shares. Just remember though, always do your own due diligence, never copy what they do. Now before we do take a look at their results as well as dividend safety, just to let you know, we've released our latest free weekly article. We're looking at the best recession-proof stocks for your portfolio. If you want access to this or any others, all completely free, do click on the pinned comment below. You can gain access and read, for example, the website's resources we use to find undervalued companies or 20 undervalued dividend stocks that you should consider to add into your own account. So let's take a look at their latest results. Now, a few things that we just want to remind you. First one, over the last quarter, so Q1 2024 versus the same quarter in 2023, they have been increasing their top line, as we can see 8% if you were to exclude the FX of FX rate, plus 11%. So this is very positive. It is something that we do want to see. And as we talked about earlier, in terms of research and development, they do have a few products in the pipeline that they do hope will continue to increase their top line. But as always, none of this is guaranteed. We then take a very quick snapshot of how they've performed. Now, a few things that we want to bring to your attention. In terms of the revenue, they do see an increase, 11.9 billion versus 11.3. But one thing that we are a little bit disappointed in is that the gross margin has dropped 77.8% to 75.5%. As always, we do like to see an increase in both top line as well as margins. The other thing that we do want to point out is they have acquired IPR&D, hence why we do see the 12.9 billion payment there, whereas in the same quarter last year, very minimal 0.1. In terms of earnings per share as well, this will also have been affected due to the acquisition, but one thing that maybe you don't hear too much of with BMY is the fact that they have done some nice share buyback, going from 2.113 billion to around 2.023 in the more recent quarter. We then take a look at one thing that maybe has gone under the radar as well, is that they are looking to save around 1.5 billion worth of costs by the end of 2025, and what they are looking to do with this money is to essentially reinvest it into the highest potential opportunities. And as we can see here, a few different areas that they are looking to focus on with these nice savings. In terms of the capital allocation, three key areas where they look at. The first one is prioritization, the opportunities, which is very key for a company that essentially is looking at new products so they can continue to increase their top line. But also in terms of their balance sheet, it is something that we did talk about very briefly. They do have a very high debt level. They are anticipating paying down around 10 billion over the next 2 years. Always a great sign, especially for a company that has a lot more debt than cash. So this is a fairly positive thing if they can stick with this. Second is not just the increase to their dividend growth, which we will cover, but the fact that they are returning excess cash through those share buybacks. As we can see, 5 billion in share repurchase authorized as of March 31, 2024. Then we move on to their earnings per share guidance in particular. Now, it does start from a position of 710 to 740, and the reason that it does end very, very low, which also impacts the P that we did see very high at the beginning of the episode, is mainly through the deals, as we can see the effect, the acquiration of IPR&D impact, as well as we have here Razy Bio and Karuna, making it around that low figure that we can see. So something just to factor in if you were thinking at the beginning, why is it so low, or why is the PE in fact so high? But this is the main reason, and when we do come to our valuation, we will factor this in. And in terms of the actual guidance, not much change. In fact, as we can see, their top line, they are anticipating for the full year, low single digit increase. In terms of the revenues, if you want to exclude the FX, again, very similar. Gross margin, 74%, so they are anticipating it to be lower again. Not something we like to see, something that I would say keep an eye on, although the 74% target right now is still very strong. And as we can see here, their tax rate is going up significantly to 69%, although again, this is one of the reasons why that acquisition has really hit their numbers, tax rate as well as their diluted earnings per share. Now, what we're going to do is jump into the dividend safety score, also run into the valuation. So a dividend safety score 70, it does look to be safe. Market cap 82 billion. A large cap company. Now we can see their dividend safety was just reaffirmed a few weeks ago. This ultimately means that their dividend cut does look unlikely for Bristol-Myers Squibb. We then take a very quick look. Last recession, they maintained the dividend during the 07-09 crash. They had negative 21% recession sales, remember below average, which was negative 12. They also outperformed the S&P, negative 32, with the S&P returning a very poor negative 55. Now for a company where you have a yield touching 6%, it is quite nice to note their latest increase was 5.3%, which is above the inflationary rate we target of 4%. Over the last 5 years, nice at 7%. Over the last 20 years, at a bare minimum, they have been increasing it in line with inflation. And we do notice 17 years of consecutive increases, with 53 years of paying a dividend without a reduction. Now, for those that are new, essentially dividend yield theory states a company is undervalued when the current yield sits above the 5-year average. We have a severe undervaluation signal, as well as probably the highest yield they have offered over the last 5 years. And when we do exclude those one-off items, their forward P of 5.9 is also below the 5-year average of 8.9, as well as significantly lower than the healthcare sector of 15.7. So we do have a triple undervaluation signal. Just bear in mind that we're not looking at any of these models in isolation. We then move on to the free cash flow payout. We do ignore the earnings, which is susceptible to manipulation by management through accounting. Free cash flow also helps us spot any potential dividend cuts, and below 50% is the target for biotech, pretty much from 2018, so we're talking about the last 6 years, it's been below that. 2024 anticipated again to be lower at 35%. We then move on to the free cash flow, which is actually very positive for a company that has been hammered over the more recent period. It has been increasing like we want to see over the longer term. 158 to 611, 2024 anticipated to continue to increase, so that is a fairly positive sign, maybe not one you would have expected given how bad this company has been hit in terms of the share price drop. We do like to see 3 to 7%, as we said earlier. This is just showing it in percentage format. The last 2 years, not the greatest, but before that, it was pretty strong, as we can see year on year. And what we have said for the forward guidance from the investor presentation, very low single-digit increases. Total sales then, pretty much what we did discuss earlier. And in terms of shares outstanding, we like to see returning of excess cash through those share buybacks. What we can see is net dilution over the longer period. Although if you have been a shareholder since 2020, they have been buying back those shares. And as we did discuss already, they are looking to continue to do that this year as well. So a very good sign, especially if you are a more recent shareholder with this company. ROIC then, this very important metric, 10% or more to give us faith management are able to effectively allocate their capital. Above 25% for biotechs, I personally want to see 10% or more. So for me, this is okay, as we can see over the last 3 years. It would be nice to see them go back to the highs that we saw around 2016 to 2018, although these numbers still make it attractive for potential investors. We then move on to the operating margin. Above 25%, we can see they have struggled, but it is pretty much straddling around that nearly every single year. 19% in the more recent year, maybe something just to keep an eye on, as it does look like it has been decreasing over the longer term. And on the free cash flow, no real worries there, especially since 2017. It's been above 20%, looking very healthy, 27% as well on a trailing 12-month basis. Now, probably the most important metric for essentially the balance sheet strength as well as dividend safety is the net debt to EBITDA. The earnings before the interest, tax, depreciation, amortization. We want below 1.5 for biotechs, and remember, these are the number of years it would take the company to pay off all of that debt net of cash on hand. Pretty much below that over the more recent period or thereabout. 2024 expected to increase very, very high to 5.63, something that we would say just bear in mind when you are looking at a company that has a yield of around 6%. Although the payout ratio is low, just something that we don't want to see get out of hand. Currently, I would say this is a fair red flag indicator. So let's jump into the valuation model. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually able to receive these videos as they drop. We then move on to the first model that we're using today. It is the Graham's valuation formula. Now, we're using the lower end of the earnings per share adjusted for that acquisition at 7.1 with a growth rate of 0 over the longer term. And we have a AAA corporate bond yield of 5.23. Giving us here an intrinsic value of $42. Now, we do have an undervaluation signal. Just bear in mind it isn't too far off, so you could argue reasonable valuation based on Graham's formula. But remember, we're not looking at any one of these models in either. We then move on to the model which is the dividend discount model. Now, we have very nice increases from BMY. And again, remember, they do pay a nice starting yield of 6%. Average growth, 8%. We do want to be a lot more conservative, at least in line with what they've done over the last 20 years of 4% and keeping up in line with inflation. We still get a very nice undervaluation signal, pretty much showing over 50% upside. We then move on to the next one, which is the DCF model. And we have the free cash flow year on year, as we can see here, average at just under 30%. Now, we've been a lot more conservative, a little bit more conservative, in fact, than management and analyst estimates, negative 4%. With a discount rate, we get the present value of future free cash flows, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and we can see another undervaluation signal. So the intrinsic value here is just the average of these models that we just ran through, and it does get to around $51.54. Also, remember you can grab a copy of this model by clicking on the pinned comment below, getting to both intrinsic value and acceptable buy price of companies in your own portfolio, as well as those on your watch list. Now, margin of safety, 10%, as we always say, we start off with and execute if it meets our 3 criteria. Wide moat, strong financial metrics, good forward-looking data. Then we keep going till it's near the current trading price, and in today's episode we can pretty much see a 20%, not there at a 25, which should be around $39, a 20 to 25% margin of safety. Now, depending on investors, some may find that sufficient, some may say they need a little bit more given the risk associated with this company. When we take a look at Wall Street, well, they see 30% upside. Their price target is $52, so they do see this as a very good company to consider for the portfolio after doing your own due diligence. 20 to 25% MOS, 30% upside from Wall Street, and a starting dividend yield just under 6%. As always though, do let us know your thoughts in the comments below. Is this one you're looking to add? Maybe one on your watch list, or maybe the complete opposite and you are considering selling. As always, if you enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.